Welcome back to Skyrise Investments. You are watching the Market Mastery series, your journey from zero to stock market pro. In the last episode, we have learned the difference between a private and a public company. Now that you understand what a company is, the next big question is, why do companies issue shares in the first place? Why do they offer ownership to strangers like us? Today, we are going to decode this in the simplest possible way. If you are learning something new with every episode, then hit the like button, subscribe, and turn on the notification bell, because this series is designed to make you a confident investor step by step. Let's begin with why companies need money. Every business needs money to grow. Whether it's opening new stores, building factories, hiring employees, buying technology, or expanding into new countries, everything requires capital. There are two primary ways companies raise money. First, debt. It is borrowing money, like loans, and second is equity. Means selling ownership, like shares. Debt has to be paid back with interest, which increases financial pressure. Equity, however, does not need to be repaid. Instead, the investor becomes a partial owner. Did you ever wondered, why not just take loans? Some companies do start with loans, but loans come with limitations like banks need collateral. Interest must be paid regardless of profits. High debt increases risk. If a company wants to grow faster, expand globally, or compete with giants, loans alone may not be enough. That's where shares come into the picture. Now let's understand why companies issue shares. Companies issue shares because they want money to grow, but they don't want the pressure of repayment. Also, they want to spread risk among investors, and even they want to scale faster. And last but not the least, they want credibility and public trust. Selling shares gives companies more capital, more reach, and more opportunities. Now let's see some real-world examples. Infosys became one of India's biggest IT companies because it expanded using public money raised through shares. Amazon in the USA issued shares early, allowing it to grow from a garage startup into a global empire without taking unmanageable loans. Today, millions of people globally hold shares of companies like Apple, Google, Reliance, Tata, etc., and they indirectly fund the growth of these businesses. So, when companies issue shares, both sides benefit. The company gets money to expand, and the investor gets ownership and a chance to profit if the company grows. Also, if the company performs well, share price increases, investors make profit, and company becomes stronger. This partnership creates wealth for both the business and the shareholders. Let's summarize today's discussions. Companies issue shares because raising equity is one of the best ways to fund growth. Instead of relying only on loans or private investors, companies sell ownership to the public. In return, investors get a share of the company's success. It's a strategic move that reduces financial pressure, spreads risk, increases trust, and helps companies scale rapidly, both in India and globally. If this episode helped you understand the purpose behind issuing shares, then like this video, share it with someone learning the stock market, and comment, "I'm learning." To continue this journey, subscribe to Skyrise Investments and let's rise together.